I look forward to going over a lot of the details going on in the housing market today.
Awesome, awesome. Well, thanks for joining us. I know you're pretty busy. What we're going to do is we're going to jump into national news first. President Joe Biden, I think on the 16th, they came out with a proposal. I think this has been on Jeff Biden's list for a while as far as to boost home ownership in America. So he kind of came out with this plan where he's looking to do, I think it's called a neighborhood home tax credit, where he's looking to give $16 billion out there. Now, again, people, this is not law yet. Okay, this is a proposal. So he's proposing this. So, what do you think about that? Have you looked into it?
I've been following it. So on the local level, there's a lot of organizations that offer similar tax credits or at no cost home repair for low to moderate income borrowers. That's always going on. Philadelphia has a plethora of that. So it's something you definitely want to look into if it's something that might be something that can help you, especially in Philadelphia. If there's like deferred maintenance on your home and you're having trouble getting a home equity line of credit, you might not have the equity, you might not have the funds. But it's definitely something you can look into. There was actually a great Philadelphia Housing Development Corporation had a great housing fair over the weekend. They were actually talking about that. They had representatives to discuss opportunities to be able to rehab homes that otherwise wouldn't be affordable. So this will definitely help add to that on a national level. But in our market in Philadelphia, it's something that's always ongoing. So if that's something that you're looking for, there's plenty of resources available.
Okay. One of the interesting things that I felt when reading the proposal was that he's looking to dedicate $10 billion for individuals whose parents didn't buy a home or were never homeowners. I guess, how would they police that? That was one of my questions. How would you think they would police something like that?
So that's actually interesting because there's New Jersey's also coming out with a program similar, a grant for first generation homeowners. We'll use that term, not just first time home buyer, first generation home buyer. I honestly, I can't even tell you how you do it. Because as a loan officer, right? So when these laws come into place or they have an initiative that they want to perform, it always comes down to the loan officer. They're the ones that are going to have to be on the front line to figure out, like, does this person qualify? How much information, or how do you obtain the correct information that'll satisfy that requirement? To give you a side comparison, there was Fannie Mae came out with a initiative where they were given a $5,000 grant plus other credits. There was a handful of lenders. We were one of them. But when they talked about how to deploy it, it became very complicated. So if you were, it had to be specifically in a majority African-American community. It wasn't just like a minority. It was a specific zip codes, etc. It got complicated. It also wasn't competitive with other products that were being offered. So it wasn't successful, but that was a good indication of it was a good initiative. It was just difficult to deploy and to actually deliver to the community. So.
Okay. I guess maybe being in Philadelphia, like you had mentioned before, we have a lot of programs already. But this is on a national scale because, as we all know, real estate is super local. One of the other things when I was reading this proposal is that there's $100 million for down payment assistance for people in, I guess, the lower wealth bracket. That's something that we have already in Philadelphia. Is that something that you see in the tri-state area overall, for example, in New Jersey, in Delaware also?
So every county gets their funding. So Philadelphia, the most common one is the Philadelphia First Home Grant. That's the one that's up to $10,000, 6% of the sales price up to $10,000.
Right.
Jersey has similar ones. Delco has similar ones. That one's up to $6,000. So depending on the county you're looking for, I mean, that's where they all get their funding. So it's always good to hear when there's going to be a replenishment of funds on a national level, from the government.
Right.
But yeah, like Philly also has, like, if you've heard of Urban League, it's a housing counseling agency.
Right.
Currently, they were given up to $3,000, depending on your income, depending on location. It's now down to $2,000 because of funding. So when the funding depletes, but it's nice to see these initiatives coming through so that there's always going to be a replenishment of those funds. That's literally, in my opinion, what's keeping the housing market in Philadelphia going, because the rates went up so fast. that you need that additional funds to either buy down the rate or just make the housing that's already so high more affordable, because you need the extra down payment, you need the extra closing costs. So.
Okay. And that kind of jumps into the next segment as far as the Philadelphia market. I really wanted to, because of course we serve the Philadelphia market and the surrounding states, but I guess what have you personally been experiencing in the Philadelphia market with the swift changes in interest rates?
So I'll talk about the negative part. I mean, nobody ever wants higher rates.
Right.
On the ground level, having to tell somebody that was pre-approved before for a certain amount that they're no longer in that category. Like, so say they're approved for 200,000, you got to drop them down to 180, maybe 175. It's a difficult conversation to have because of how fast it happened.
Right.
So like me personally, I've never experienced rates rising at the rate that they were rising so quickly. So like sometimes if somebody takes a longer amount of time to purchase a home, that's fine. But I mean, we could be talking about a week, 2 weeks, a month. Like you can be getting that phone call, like, listen, like we're going to have to reevaluate your pre-approval.
Right.
So that's been difficult. I will say that the first-time home buyer, again, nobody's happy about the rates. They're not as sensitive to the rate. They're more looking at affordability. Because again, the thing to compare it to, and I see a lot of interviews with people that deal with what I call like high net worth borrowers. They're looking at, okay, well, I live here. Here's my payment. Here's my rate. I don't really want to make a move. But like I deal with borrowers that their need is they have to move. They need that home. They need to get out of either the neighborhood. They want to be in a specific school. Like they have to make a move. Now, our more difficult job now is figuring out a way to piece the pieces together so that we can make that happen, which is, again, utilizing grants or low down payment or no down payment mortgage products.
Now, have you seen people fall off? Like you said, these people have to make a move, but have these higher interest rates made them take a seat on the sideline, even though they have to move?
Some had to make a more difficult decision of, like the common rebuttal, if you call it a rebuttal. When you tell them the new dime, I'm not going to find what I'm looking for at that price range, but there's our job. All we can do is deliver the numbers.
Right.
Like I know what the end goal is of, you need a certain amount, but in terms of affordability, that's not going to change with the price that you're eligible for. It also goes hand in hand. And sometimes like people get out of pocket because they might have just, you hear the common things. They just bought a car with a cost that's just astronomical.
Right.
You probably know by now, like student loans are now being kicked back in, so there's no more forbearance. So in terms of affordability, if you have an income-based repayment at zero, that's great. But certain people that are working, like you have that additional expense now that you're going to be incurring. So that's that's the thing that I've been seeing most in terms of like, are they taking a sideline seat? It's just taking longer because they're just not ready to jump from a place they don't want to be and buy a home in a place they don't want to live. If that makes sense.
Yeah, definitely. I mean, I've kind of been seeing the same thing. Like you said, these people have to move. So it's okay if I don't move in this property, maybe this property. Have you seen people maybe switching products, maybe going from a FHA loan, a regular FHA loan to a 203K, or ARM? Have people been going into ARMs to get the rate down?
I've seen people do ARMs. What a lot of people were doing was like the bond loan. So PHFA, which is one of the products I specialize in, it's the Pennsylvania Housing Finance Agency. They have a reduced interest rate. And for Philadelphia, it is a tailor-made product. I mean, you're talking about the rate today on a conventional 3% down, 6.875, which, again, in a market where all you keep hearing is 8+.
Right.
It helps with the affordability. And in a few minutes, I'll show you the comparison of mortgage products. Okay. So each product has a nuance that can help deliver to the finish line. It'll help deliver you to the finish line. Okay. If PHFA has a lower debt to income ratio, so if somebody was getting a PHFA FHA, the debt to income is 45. Then you get the phone call like, I found my dream home. This is it. But the debt to income is going to be 50 or higher. FHA might allow that if we get an approval. So then now you have to pivot, and then you have to now take the new payment, which is going to be a higher interest rate. But again, the goal is home ownership. What do I need to get into the home? And obviously, hopefully stay there long term and not be put in a financial strain. And one thing I do always want to add, there's always additional factors, such as there might be other income in the home that we're not able to use. So even though in the bank's eyes, the borrower looks like they're straining it by being at a high debt to income level,
Hmm.
We do recognize sometimes there's other income going in that we're just not able to use as qualified income. So,
Right. And I've run into that a couple of times where they can't use the income. Actually, I had one person who just closed where because they couldn't use all of their income, they had to lower the amount of the loan,
yep,
which made them bring more to the table.
yep,
Um, what I have been seeing is it looks like, and this is great, is that lending companies and banks are coming up with more creative ways as far as to get individuals into the home.
yep,
Back when interest rates were 2% or 3%, hey, the interest rate was the reason why you should be buying this home. But now it seems like because the interest rates are over 8% right now for the 30-year fixed, that lenders are coming up with more creative ways to get individuals in the home. So, I mean, as far as down payment assistance, there's levels to it. You have the local grants, you have the state grants, and then you have the proprietary products of different mortgage companies and lenders. So
yep.
if you want to start at the local level, we have the Philadelphia first time home buyer grant. And then on the state level, I think that's what you was talking about as far as the PHFA, correct?
Correct.
Okay, great. Won't you break that down a little bit more as far as, okay, if somebody does want to look more into it?
So the PHFA one, so PHFA and the Philly First Home, they don't go together. So
Right,
there's a word you can become familiar with, like, is it stackable?
right,
Because both of them want to be in second lien position, which means like there's going to be a first mortgage, and then the grant itself will be a lien against your property. PHFA wants to be in second lien for the grant, which is 5% of the sales price. So just even numbers. On a $200,000 purchase, they're willing to give you $10,000 forgivable in 10 years
yeah,
and 10% forgiven each year. Philly First Home will give you 6% of the sales price up to $10,000, but the 10,000 is the cap. So that's another option. Again, they don't go together, and I can show you. So that the down payment part, you hit the nail on the head. Other lenders, all lenders usually have an internal proprietary down payment assistance, like a grant.
right.
We have one up to 2,500. There's other lenders up to 10,000. So it just depends on what you qualify for.
Okay.
And some of them are stackable. And that's really, again, when we're talking about affordability, how much can you put together?
Hmm.
Because there's two things when you're talking about unique opportunities for people to buy homes, like to get creative. You probably heard a term like seller buy down.
Right.
So if the seller is willing to give a certain amount of seller's assist, you can use that to buy down the rate, like 2% the first year, 1% the second year, which is a good initial opportunity. But you also want to be cautious because I feel like sometimes people are desperate to get into the home. They look at that as like a Band-Aid, but what happens if, because we never know what's going to happen tomorrow, if the rates don't come down,
Right.
and now you're at the full rate, and now you're in financial stress. So some people, it's a tailor-made opportunity. Some people just have to be cautious because if you're stuck in the loan, it could be an issue, especially if there's an additional lien and you might disqualify yourself from being eligible to refinance because again, you're already putting down low down payment plus you're stacking a grant on top.
Okay.
So
All right, so let's slow walk that because of course we know we talk about because we're in the business. But somebody for most first time home buyer, this is their first time, so all this information is new to them. So if I'm going into a home and just say the home is 8%, the percentage, and then I buy the rate down. If I buy the rate down, for example, I get $10,000 from Philly First. Am I able to use that money to buy down the rate? And if so, is that for the duration of the loan or is that just for the first couple of years?
So there's two things: the temporary buy down, which
Okay.
is the one I was saying about the what I call like they came out. It's always been there.
Okay.
It's just it wasn't obviously as popular. We were in such a low rate environment for so long, nobody did it.
Mm-hmm.
But it became popular again when the rates went up. That's a temporary buy down. What they put it basically what they're doing is they're putting a certain amount of money aside for what the rate would be 2% lower for 1 year, 1% lower the next year. Or you could do a rate buy down where you're basically by paying a point, which is 1% of the loan amount,
Mm-hmm.
you're lowering the monthly payment over, you're lowering the interest rate for the term of the loan.
Right.
That's the one I would lean towards. So when there's additional money and you're stacking grants and seller's assist, I'm seeing people buying down the rate more than I've ever seen before. Obviously because of the environment as well, but there's also so much money going into the pot
Mm-hmm.
because again, people that are buying right now are able to ask for a seller's assist. And one thing I just want to make sure that we're clear on,
Uh,
although the rates are high, people forget what happened when the rates were at an all-time low. A first-time home buyer to buy that house, almost impossible.
right.
Like you need the stars to align. You had so much competition. You had people making offers on 20-plus homes. And never in my career have I ever seen that, because it was just a perfect combination of low inventory, ultra low rate. So yeah, it was great. It was more affordable. But if you look around of how many images you saw on Facebook of people actually buying their, first-time home buyer, because you had so many investors come in, you had people moving from New York
Right.
to buy in Philly because it was cheaper.
Right.
I mean, so we just got to take this as an opportunity for a first-time home buyer to have less competition to get in the home. So if it's affordable, in my opinion, for a first-time home buyer, it's one of the best times to buy, because that's why you're seeing these sellers assist. That's why you're seeing them allowing you to come in with a PHFA loan or an FHA loan and then taking it. So it's nice to see that. I mean, again, I'll always refer back. Nobody wants to see the high rates.
Right.
But what it allows somebody to have the opportunity to do, which is purchase the home. And they always say that corny phrase like, marry the house, date the rate.
Right.
I mean, it's unfortunately it's true. It's like if the rates drop, you now own your home, you have the equity, refinance to a lower rate later.
Right. And I do see people on the internet. Some people try to discredit that and say, "Oh, well," I'm like, "Okay, well, yeah, you could stand on the sidelines, but what happens when the rate comes down? When the rates come down, like they will eventually at some point in time, then everybody floods back into the market."
And what does that do to the sales price when everybody floods back into the market? You're paying for it one way or the other, whether it's rate or equity.
Right.
If the rates dropped, everybody saw how fast housing prices went up.
Right.
So if you actually looked at the numbers side by side, it's a mind game. It's like, oh my God, I got an ultra low rate, but what did you pay for the house? All you kept hearing about was no contingency, 50,000 over asking or more.
Right.
You can't compete with that.
Right.
So
and that's people. I'm sorry. Go ahead.
But this is the opportunity. This right now, I think, is the golden time where a person can utilize everything they're entitled to. Meaning, if you're eligible for a bond loan, the seller's not going to say, "No, I don't want that. I'm waiting for that conventional loan with no contingency or cash." You're not seeing that anymore. So now you can utilize a loan that's actually right for you. FHA, which is also a good option, took a lot of people out of opportunity, because if every offer that was made on the house was conventional, for the first-time homebuyers that aren't familiar, FHA is like a redheaded stepchild to that opportunity. So even though FHA might have been your only or best option because it was the cheapest option,
right,
the seller is going to say, "No, we're going to take a conventional offer over FHA."
Right.
As well as aside from now, you can get that FHA offer accepted. So now you're at least able to use the best financing for you with a seller that's willing to help and provide a seller's assist when necessary. I think it's great. And if, when you're ready, I'll share my screen on what these numbers look like side by side, so you can actually see the comparison, how FHA stacks up against a bond loan versus a conventional loan. So you just let me know when you're ready.
Yeah, let's jump into it.
All right, I'm going to do that now. Presentation, and then I can make adjustments as needed. So what you're looking at right here is, I think, what most first-time homebuyers don't get the opportunity to see. The average loan officer is going to send you, okay, if they pre-approve you, they'll give you most likely one option, one number, one rate, and they don't really show you, well, how did I come up with that being the best option for you? Not even knowing if that's really what your goal is. So what I do is I do these live presentations. So a couple things happen. One, I know what you're looking at because everybody likes bright colors. So across the board here, this is a $200,000 purchase, which I think the area median in Philadelphia, $200,000 is about a good average to do. Yeah. The loan amounts here are mostly the same. It's a conventional option, 3% down. That's usually the average, the minimum 3% down. And against an FHA option, which is the last column here. And what it allows me to do is to show you what the difference in the monthly payments are, which is obviously what your biggest concern is, affordability. Mm-hmm. So you see it down here where it shows you what the monthly payment is. But as I highlight it, you can see it side by side, same scenario, what really gives you the lowest overall payment option, right? You'll see this down here. It actually just shows you in green or red. So right here, Freddie Mac Home Possible is the 0, which means that's the highest payment overall. Side by side, it just tells you which payments are also has the best savings.
Okay. What
I like to show in terms of affordability of a plan overall, right? So you have 6.875 here, you have 8.125, 8.375, and 7.625. These are current rates as of a couple of days ago. Okay. The reason this one is as high as it is, Fannie Mae Home Ready, when we do this loan, We deal with no mortgage insurance. So that's something important to keep in mind. So even if somebody were to offer Fannie Mae Home Ready with a little bit of a lower rate, they're still adding in the mortgage insurance, which kind of negates the savings of a lower rate because
Right.
you're adding mortgage insurance on top.
And that's conventional, right?
Yeah, that's conventional. All three across the board are conventional.
Okay.
This one, the reason I show this, the 6.875, I usually pair this with the Philly First Home.
Okay.
So that way you get the lowest possible rate here.
And you're buying a rate down there?
We're not doing any rate buy downs yet. So
Okay,
this is what I call like the baseline, right?
Okay.
So anybody gets educated, you want to start at a baseline.
Okay.
This also shows you savings over time.
Okay.
But again, down here, how much interest in MI are you really paying over the course of the loan?
Mhm.
So I can adjust this for 15 years, 10 years, 5 years, whatever it is, and it changes in lifetime. So I'm going to show you that how you and I are going through it, how I can customize it quickly to make you comfortable with the decision you're about to make, which is buying a home is the biggest decision in your life. To be able to see, like, here is the lowest overall interest in MI paid in 15 years is $207,000.
Mm-hmm.
$222 for the Fannie Mae with no MI, which I think is interesting because if you look at the difference, you're talking about 222 to 207. It's not astronomical, but look at the difference in the rate to be that close together because you're talking about it's well over 1%.
Right.
And this is why. So this is what it all comes down to. This variable. The mortgage insurance that you're going to pay.
Mm.
That's really, so the rate by itself is not enough. And the problem is with so many lenders out there fighting for their borrowers, they might tell you I got a lower rate, but they might not show you the overall picture of, okay, you can have a lower rate, but you might have very high mortgage insurance potentially.
Gotcha.
You got to be able to look at the whole picture of what's the overall monthly payment, or something we all got to talk about, how many points. So if I go to the Fannie Mae Home Ready,
Mm-hmm.
how many points is it going to cost you to get that rate? Because that's going to change the affordability, obviously. So if somebody just comes to you and they don't even tell you, they just show you, hey, I can get you instead of 8.375, they might change it to a 7.875, and they'll just charge it on top of the cost and not tell you that they're charging you points. And I'm seeing that more now than ever because when I'm presented an opportunity to compete with a deal, I ask them, what do you know about this deal? What are you looking for? Can you beat the rate? And I'm like, have you paid attention to how much it costs you to get the rate?
Right.
It's scary how often the answer is no.
Right.
Realtors included, because sometimes the realtor will send a loan estimate and say, is there something you can do to do better? And I'm like, you really should see how much it's costing them to get that rate. So, because that'll change your cash to close situation.
Right. That mortgage insurance. Wow.
Mortgage insurance is the big factor. That's why the rate by itself. So interesting enough, FHA ends up being the cheapest option.
Mm-hmm.
Interestingly enough. I'm sorry. FHA has the lowest monthly payment. So this is just to show you this last part. These are the two that have the lowest one. So this one's 14, actually right now, 1470. PHFA, see, took the lead again. Before FHA was a little bit cheaper. 1478. So FHA was $8 more. And now PHFA, which is why I've been preaching this product, but you got to be careful. You got to work with a loan officer that knows how to do PHFA loans.
Okay.
It's an incredible product, but with the wrong loan officer, it's a disaster because you don't have time to make mistakes and to figure out how to do the loan. For the same reason, people like you mentioned when you and I first started talking, am I seeing 203K loans? Personally, I don't do 203K loans only because like I spend enough time with first-time homebuyers. The additional work that's required for 203K is just not what I specialize in. So I chose to specialize in this, doing these bond loans, but also doing them where you can still close in less than 30 days. So
now PHFA, they have a multiple different loans. Is this the K-Fit loan or is this another?
So this is just the Keystone home loan.
Okay.
K-Fit, the rate would have been like 7.375, but then you get the additional grant. So this is where I start customizing it for a borrower that like, did you do the counseling to get the Philly First Home or do you have to do the K-Fit?
Okay.
Because the income limit, just to show you, like when people say low to moderate income borrower, in Philadelphia for a 2-person household, it's $137,000 to qualify for the Keystone home loan.
Right.
That's a lot.
Right.
Like I almost never come across a scenario where, and you don't have to be a first-time home buyer. Philly First Home, you have to be a first-time home buyer or not own the home for the last 3 years.
Right.
PHFA in Philadelphia is a targeted area. You don't have to be a first-time home buyer. Like the amount of people that it satisfies that need, it's like almost everybody qualifies. As long as you have a 660 credit score, that's what you need to get the K-Fit. So just throwing that out there.
Gotcha. Now, does it always work out like this? As far as, I mean, right now for the monthly savings, um, yeah, like you said, the PHFA or the Fannie Mae Home Ready. I guess, does it work out like this in every situation, or is there situations where maybe the FHA option might be better, or it all depends?
It all depends. This is averaging like a 660 credit score.
Okay.
The higher the credit score, this number would have also been reduced because as with PHFA, like the higher the score, the lower the mortgage insurance.
Hmm.
FHA standard across the board. But if you look at it, it's interesting here, 8.375 and 6.875. Now, numerically, when you hear the difference, like you hear a 6 and you hear an 8, right?
Right.
6.875 versus 8. The difference here is $4, right?
Wow.
And why? Because of this. The 195 you're adding on versus no mortgage insurance.
Right.
But if imagine yourself as a first-time home buyer, you never bought a house before. You're listening to this. You have to. Your brain has to understand, like, why is an 8.375 monthly payment so close to 6.875? Because everybody wants to hear that 6.
Right.
You know, you just want to hear that no number.
Right.
And the way I have to explain it is, you see these two numbers, how much interest and et cetera you're going to pay, because at a certain point, the mortgage insurance falls off on this product. And again, first-time home buyers got to remember, it's not for life. So when you do the amortization, when the MI falls off, the 6.875 becomes a better deal.
Wow.
And the question a first-time home buyer needs to ask, how long do you plan on staying in the home? Because if you only plan on being there for 5 years, then this might be the better option. So that's why, like, every borrower should have the opportunity to figure out, like, what are the true opportunities? What's really the best overall cost? And this is the technology that we use to deliver that information.
Oh, wow. Yeah, that's crazy.
Yeah. So,
all right, let me take this off.
Yep.
Screen. Okay, there we go. Okay, yeah, that's super interesting. Now, I know that's a proprietary tool. Is there have you found that online anywhere where somebody could do it by themselves, or they really have to contact, I don't want to say contact you, or contact a agent that has that type of software?
So the software, it's a third-party software.
Okay.
But to fill it out accurately, I mean, you need a lender to do it. It's just
Right.
there's like what I call like a old school. It's called the itemized fee worksheet. Right. I think in Philadelphia, like when you have to have a borrower sign a buyer's cost sheet, and it's just a list of numbers,
right,
which is fine. The problem is, like, when you're educating a consumer, you want to show them what the options are, what's really the best option. You know, that there's not only one size fits all situation. Right. And that's how I do it. And I even use that tool. So if somebody tells me that they applied with ABC Lender, they send me their estimate. I add it to that sheet so that I can show them side by side what's the real savings.
Gotcha.
And sometimes we're the best, sometimes we're not. But at least they'll see it to know why they're not, why it's better, why it's not. So.
Okay. Sometimes what I run into, and this just personally with banks, is their processing is a little tough. I guess, what's been your experience with Fulton as far as processing goes? Because it sounds great on the outset, but then the processing gets a little bit wonky.
So 2 parts to that answer. One, I average to clear a borrower 10 days. That's my average. In order to do that, 1, you need to be a very good loan officer. And 2, you need to know how to work with your buyers up front properly. So when they say, I mean, really, I got to be honest with you. Like, I've worked at different lenders. It always comes down to the loan officer.
Oh.
Because you could take the same loan officer in a bank environment and you'll say, like, it's long. And one of the other thing, it's something we have to be cognitive of. Underwriters are allowed to ask for whatever they want, technically. Right?
Okay.
My job as a loan officer is to know what the guidelines ask for. I've had commitments come out where they'll ask for a few other conditions. I review it and I say, listen, we don't need this, this, and this. Unless you have a reason that you're adding it, we need to remove it. And it gets removed. Other loan officers complain about it. I just more address the issue and say, listen, like, they're human just like we are. Right. So you don't know what the cause of them is. It could have been a mistake. But you could take that same loan officer. That's why you'll see, like, in my opinion, I know there's a handful of loan officers in the Philadelphia market. You just know they're good. And it's never about where they are. They're not like, oh, this person is good because they work at this lender. Okay. They're the reason that the process is good. And that's why, again, like, we have loan officers, even at Fulton. They want to do a PHFA loan. They tell the borrower and the agent, 45 plus days.
Right.
I tell people under 30. And I have a process for it. Other loan officers don't. So working at a bank, like right now, especially inventory is also a reason for that, like, volume's down. But if you do the job correct, just for the same reason, if a realtor does their job correct, the process is smoother. I've worked with realtors that have no idea what's going on, and I've seen deals explode. And then I've seen deals that should have died,
Right.
but the realtor just glued it, like helped glue it back together.
Right.
So, I mean, I'll come down to like as a lender. Now, keep in mind, you'll notice it says Fulton Mortgage Company. We're an independent part of Fulton Bank. Like we're an arm of the bank. All we do is loans.
Okay.
So we incorporated, we invested in top technology. So what we need to do to deliver the product, we have the top technology, as you can see by some of the technology I've showed you for Mortgage Coach. We do, electronic signatures, electronic packages. We have online applications you can apply from your phone, like everything to streamline and expedite the process. We have access to. Now you'll have loan officers that don't want to do it. They'll say that people want to meet face to face. They want to sign in, which I don't know why anybody would want to meet face to face.
All right.
But if you wanted to, that takes time. Or if I ask you for your documentation, you don't know where it is. If you need your W-2s, you can't find it. Or if you need pay stubs and you can't locate it.
Right.
Like there's things that just slow down the process. Or you provide multiple bank statements with a ton of deposits from God knows where, but you want to do a grant. And that's one of the things I'll say personally, I get the black eye for. People might say that like Jeff asked for more, or like it's harder to deal with it. But if you're doing a first-time homebuyer program with a grant, they're going to ask you for more.
Right.
That means if you want to use child support, we need the court order. We need to show payment history, as opposed to like somebody that's not using it. They're asking, why are you asking for so much more information? Or why are you asking for these additional deposits? Because you're asking for grant. And I get the black eye because sometimes it gets blended. I was like, if you weren't using a grant, you weren't using a first-time program, I don't need anything from you. We would have been done 2 weeks ago.
Right.
But,
No, I get it, because I tell people up front, listen, they're going to ask you for everything. Prepare to be frustrated with the situation. But here's the thing. When's the last time somebody loaned you $200,000?
Exactly.
When's the last time somebody loaned you $300,000? It's probably never happened. So you haven't experienced this type of accountability. So, hey, you kind of either want the loan or you don't. I don't say it like that, but
Philadelphia has I deal with a lot of people that work at like say Comcast, UPenn, et cetera, like the hospitals. So there's actually a way where we pull that income information online. We also do true underwriting up front. So like the person goes through the underwriting process. I do that to everybody.
Okay.
Because if I can't get you underwritten up front, what's going to happen when you sign the contract and the clock starts?
Right.
I'm not going to start figuring out like, okay, now you got to locate these items and now we got to have an underwriter review it who might disagree with the income.
Right.
But there's technology available where I could actually I've gotten people pre-approved. I never asked them for a document because all of the income was online.
Okay.
That means they had stability in the employment. They weren't jumping from job to job.
Right.
There's consistency in the trend of the income. And Fannie Mae and Freddie allow you to basically automate that approval where I don't have to ask you for anything.
Right.
So we're just as fast, if not sometimes faster than the independent mortgage banks, meaning the lenders, correspondent lenders. So it'd be something that I work on. That's why you'll see me post a lot on social media. Like you can do PHFA in less than 30 days. You can. You got to do the process right.
Right. Right. Correct.
Documentation, you're right. You are going to ask for more because you'll start seeing people deposit cash. Some people don't like keeping money in banks, which is fine. But then they start dumping money in. They don't understand, like, if we can't trace it, we don't know where it came from. We don't know if it's a legitimate source.
Right.
That's usually the biggest headache. And then finding out that there's debts that weren't on the credit. One thing that you might want to, one thing I started noticing coming up more and more, Affirm, Clara, like basically when you're doing online shopping and they're giving you like 6 easy payments, it's not on your credit report. But what happens is when you provide your bank statement, they're adding it. They could potentially add it to your liabilities.
Right.
And if I don't see your bank statement until later in the process, I don't know that we might have to use those debts against you. So the sooner, I always advise everybody, the sooner you can get the lender the information and get them everything,
right,
the better off you'll be, especially the ones that'll show like, here's where I bank. And then when they provide the bank statements, they'll say like money transfer from another bank account. You don't want to see anything after the contract signed because you don't know what's on there.
Right.
The overdrafts, an additional job you didn't want to disclose. I mean, it's a mess. So.
A slippery slope.
Yeah.
Definitely a slippery slope. Well, I think your overall point of view, like you said, as far as comparing, not necessarily shopping, but comparing different loans to see what's the best fit for you moving forward, and just make sure that you're taking everything into account before you kind of jump into this loan or that loan because the rate is low. Is that
So there,
correct?
there's I mean this is what I call getting into the weeds, but I thought this was an interesting change. You know, we always talk about the agencies like Fannie Mae and Freddie Mac. I mean,
Mhm.
that's become like a household name. Usually, if somebody says you're getting a conventional loan, like everybody knows those names by now. Yeah, Fannie, yeah, Freddie. 5 years ago, Fannie Mae, when they rolled out Home Ready, like at the time when we were running it with Home Ready with no MI, etc., a lower credit score borrower, single borrower, which if you look at the average purchases to take place in Philadelphia, it's amazing how many are single borrowers.
Mm,
Single borrower is a risk factor. So
mm,
Fannie Mae, at a certain point, I think like 2 years ago, we started running the same scenarios, and all of a sudden it wasn't taking it. You weren't getting approved.
right.
It seems like it flipped now. Freddie, when we run a Freddie loan, so you saw Home Possible, they started taking that single borrower, lower credit score, no reserves. So that was one of those. If you work with a loan officer that has that ability, you could. It's like one of those almost like out of necessity. Some people, everybody, if you're an A plus borrower and everybody's just throwing money at you, God bless you. But you have a borrower that like, okay, an FHA is not going to be an option because the house might have cracks and chip and paint, etc. Or the seller just says, I'm not taking an FHA offer.
Right.
Home Possible opens that opportunity back up where Fannie Mae might have shut it down.
Mm,
But you need to, again, it all comes down to the loan officer. I got to be honest with you. It's not the bank. For the people out here watching, it's all about the loan officer. Most banks have a plethora of opportunity. They have multiple products. Rarely does any bank only have one. It really comes down to the loan officer. If you ever hear a disaster, I don't
mm,
want to use names, but like mostly it comes down to the loan officer story. It's not like the bank. The loan officer is non-responsive or didn't scrub the file properly. That's usually where things start falling apart. Because we're the front line. Just like you're the
right.
realtor, if
Right.
you walk through a house and you saw like stained ceilings and you don't say anything to the lender, then we order the appraisal, and now the appraiser saw it, and now they're going to be like, okay, well, we need to figure out what happened.
Right. Right. You
But a
need to have some.
realtor that is familiar with it would say, listen, we're going to have an issue because before we order an appraisal and you spend your money, what's happening up there?
Right.
Right?
For FHA loan.
Any loan. Because the thing
Right.
is that I've had somebody say that to me, like water and mold is a health hazard. Chipping paint is a nothing thing. Like chipping paints or like little cracks, whatever, that's not
Right.
safety. But if you see standing water in the basement, you're going to have concerns because why are you have flooding in your basement? Why is there water standing there? Did it leak from the ceiling, the pipes? Like a water is could issue mold, foundation issues. That's different. But if a realtor sees it before we order the appraisal, it could become a let's address it now, or now you want the appraiser involved and figure out like now we got to get all the certs, etc.
Gotcha.
So
Gotcha.
just tips to walk away with.
No, I know where the words. All right, man. Well, listen, man. This has been awesome, man. Why don't you tell everybody where they can find you at, man?
Sure. So Fulton Mortgage Company, Jeffrey Vilk. On Facebook, I think this is linked. I always put it in. I have a mobile app that has actually a majority of the information that we discussed today on the mobile app. Talks about do's and don'ts, grant opportunities, how to apply. I mean, it's just a wealth of information on there. So I'll add that link onto the post. So once this is done streaming.
All right, man. And what's your URL, or do you have a website, or?
It's through the company, so I don't.
Okay.
So I wish I had like just a jeffreyvilk.com, but
Okay.
it's
Regulations.
if you go to Fulton Bank, you type in Jeffrey Vilk, it'll link you right to me.
Okay. And I guess because of regulations, they don't let you have a vanity URL.
Correct. Yeah.
Okay. Gotcha.
Like working for the bank, that they control all of it.
Okay, gotcha. Well, listen, if anybody does want to reach out to Jeff, he gave you his information. If you want to hit me up for his information, that's fine too. Want to thank him for coming on. And again, this is Khalid Nathan Aleem, the real estate boy. If you're looking to buy a home, sell a home, or invest in real estate, I got you, man. Any last words?
No, that's it. It was a pleasure. A pleasure talking. It was a good information, I think.
Yes, man. Definitely, man. Appreciate your time.
Yeah, of course.